Hello, Marc from ADM Investor Services International, with a slightly different perspective this week, above all on emerging market currencies and emerging market policy room in terms of their government bond yields. And that's where I would like to start with a graphic provided by the IIF, which highlights, it's got basically four quadrants to it. Basically, the top left is the ideal quadrant. Um, it's basically currencies which have appreciated and their interest rates gone down. The bottom left is where the interest rates have gone down, but the currencies have depreciated. And then on the right-hand side, where one sees the bulk of the emerging market currencies, we've got in the top right the ones where interest rates have actually risen slightly. One has to say, in case of China and Japan, it is very modest. And in the bottom right-hand corner, those currencies where they've seen depreciation and a rise in bond yields. And as one can see from that, countries such as Turkey, South Africa, Ukraine, Russia to a certain extent, Mexico, Brazil, have all suffered quite sharp moves and not moving in most ideal correction. They're all for very different reasons, and I think this is the important point to remember, that with emerging market currencies, that a wholesale rush into EM isn't necessarily the best sort of policy. One has to take each country on its own merit. So I just like to pick out four. One of them, people probably not to classify as an emerging market, but it is in the basket, and that's Saudi Arabia, which I'll come to at the very end. But let's start off with two perennial bad boys, so to speak, or one currencies which are considered to be very fragile in these situations. The first one is Turkey. As one can see, from the white line, there's been a very sharp fall in Turkish FX reserves, and at the same time as the Turkish lira has come under a lot of pressure. This is a long-standing depreciation, one would have to say, and it owes a lot to the fact that as much as Turkey should benefit from lower oil prices, its local economic policies leave a lot to be desired, particularly in a region which is politically tense. My second chart is South Africa. Again, another currency where local economic policies leave a lot to be desired. There are a lot of problems, for instance, with local electricity generator Eskom, with South African Airways, and there isn't really much budgetary room there. And as one can see, foreign exchange reserves, that's the yellow line, have fallen modestly, one would have to say, while the rand has depreciated very, very sharply. Now, those are the two perennial bad boys. Now, let's talk about the two major protagonists in the oil price war, Russia and Saudi Arabia. Obviously, very different sort of positions. Russia has seen a relatively sharp fall in its currency by recent standards after it got over the shock of the Crimea-related sanctions, and it's seen the ruble depreciate quite sharply from around the 62 level to as high as 80 versus the dollar, and it's now stabilizing somewhat. Interestingly, as much as the FX reserves fell somewhat in reaction as they defended the ruble, it's nothing like the sort of fall that we saw at the back at the Crimea time. And it probably is one of those ones which is going to prove to be rather more resilient than people think. My final chart comes with a caveat in terms of the movement of the Saudi Riyal, which is pegged to the dollar. Therefore, that movement that you're seeing there is actually within a very, very tight and within its overall peg range. But nevertheless, it highlights that people are starting to worry with that latest fall in the Saudi Arabian Monetary Agency's foreign assets, which is equivalent to their foreign exchange reserves, that the peg could at some stage come unstuck. Pegs have typically a habit of actually holding better than people think, but it is a pressure point, and it is something which we're going to have to watch a lot more closely as we go forward. And those are the thoughts for this week.